So, picture a sprawling metropolis being built overnight, right? You've got thousands of developers pouring concrete. They're laying down highways at like lightning speed.
Right, but the city planners haven't actually released the zoning laws yet.
Exactly. The builders are just guessing where the property lines are. And then every few months, a government official just drives a bulldozer through a finished neighborhood, handing out fines and claiming they should have known better.
Which is, yeah, that chaotic environment has basically been the reality of building in the U.S. digital asset industry for, what, the better part of a decade now?
Oh, absolutely. Welcome to another episode of the Token Trends Weekly podcast. I'm Max Ledge.
And I'm Sasha Coyne.
And today we're doing a deep dive into what might honestly be the single most consequential regulatory shift in the history of crypto.
Yeah, without a doubt.
So if you are, building protocols or trading markets or even just holding a portfolio, you really need to understand the mechanics of what is happening in Washington right now.
Because the sheer unpredictability of that bulldozer era we just talked about, relying on post facto lawsuits for legal precedents, it meant capital was just constantly operating under this cloud of existential dread.
Right. You never really knew where the lines were until you got hit with a Wells notice.
Exactly. But today, we're unpacking some incredibly dense source material that changes all of that. We're looking at the actual text of the U.S. Clarity Act, a landmark joint release from the SEC and the CFTC, the explosion of tokenized real-world assets, and, of course, the really fierce political pushback from major labor unions.
Yeah, it is a lot to cover. So let's just jump right into the big shift. The U.S. is finally moving away from that whole regulation by enforcement model, right?
Yeah, that's the goal of the Digital Asset Market Clarity Act, or, the Clarity Act. It's fundamentally redrawing the whole jurisdictional map.
And jurisdiction is, the crux of the entire issue here. Under this new framework, the SEC keeps its authority over digital securities.
Right, so anything that mechanically functions as an investment contract, exactly,
Yeah.
where you buy something and you're relying on a centralized team to make you money. But the crucial shift here is that the CFTC is finally granted explicit authority over digital commodities and the spot markets where they trade.
Which totally resolves that massive regulatory turf war. But, the legislation still had to answer the hardest technical question in crypto, which is how do you legally classify a token that starts its life heavily centralized, but eventually becomes a decentralized network?
Right.
And the Clarity Act introduces this thing called the mature blockchain test to solve that.
I love this part. The mature blockchain test is actually my favorite piece of the whole legislation because it finally acknowledges how a protocol actually lives and breathes.
Yeah, it's about time.
Look at it like a traditional startup company, right? In the seed stage, you've got a couple of founders, maybe some VCs, and they hold all the equity.
Right. They make every single decision. Exactly. They hire the staff. Yep. They drive the value. So because investors are relying entirely on that core group, SEC oversight makes total sense. It's clearly necessary. But then when that company goes public, ownership dilutes across, millions of retail hands. The founders step back and control completely decentralizes.
And so the mature blockchain test just applies that exact dilution model to digital assets.
Right.
The statutory threshold is actually super specific. It requires that no single entity or even an affiliated group of entities can control 20% or more of the token supply.
20%.
Or the voting power.
Yeah.
And it's not just that hard quantitative metric, there's a qualitative test too. Like if a multi-sig wallet held by 3 original developers can just unilaterally push a code update or pause the blockchain.
Then it's not mature.
Exactly. The network has to prove it runs independently of its creators. And if it passes both those tests, the token legally graduates.
Wow, graduates. So oversight literally shifts from the SEC over to the CFTC.
Right. You got it. And building on that graduation concept, the SEC and CFTC actually sat down together, which is rare, in March 2026.
Yeah, to issue that joint interpretive release. The industry had been begging for that for years.
They're literally begging. And they created this really rigid 5-category taxonomy. So they divided everything into digital commodities, digital collectibles, digital tools, stablecoins, and digital securities.
Which is vital, right? Because a decentralized compute token, a digital tool, functions completely differently than a profile picture NFT.
Right, which is a collectible.
Yeah. But the biggest breakthrough in that release is the off-ramp mechanism.
Oh, the off-ramp is massive. It fundamentally rewrites early-stage capital formation.
Totally. Think of the off-ramp like a Kickstarter campaign for some complex new piece of hardware, like a revolutionary new smartwatch.
Okay.
When you back it on Kickstarter, you're just giving them money based on a promise, right?
Yeah.
You're trusting their technical ability to actually manufacture the thing.
So legally, you hold an investment contract.
Exactly.
Yeah.
But 2 years later, when the watch finally ships and it's physically on your wrist, it's no longer a promise. It's just a watch.
Right. The contract is completely fulfilled.
Yeah, you can sell it, you can wear it, whatever. And the joint release applies that exact logic to utility tokens.
Which kills that old, always a security doctrine that everyone was so afraid of.
Yes. If an asset was sold to fundraise on day one, it used to just carry that regulatory baggage forever.
But now, if a dev team successfully finishes their published roadmap, like they deploy the mainnet, distribute the tokens, open source the client, the token can actually detach from its investment contract status.
But, and this is a big but, the nuance of how those roadmaps are worded is going to be a massive legal battlefield.
Oh, for sure.
Because if a team promises, continuous security monitoring managed by the core team, then that investment contract status is never going to fall away.
Right, because the promise of future managerial effort is ongoing. Basically, the phrasing of a random Discord announcement is now a binding legal parameter.
It's crazy.
If devs want the off-ramp, they have to define a clear finish line, cross it, and then literally take their hands off the keyboard.
So, okay, now that we understand the rules and how these assets graduate, we need to look at what institutions are actually doing with this clarity.
And the immediate impact is just this absolute boom in tokenized traditional equity.
It's everywhere. The SEC, led by Chairman Paul Atkins, proposed this innovation exemption that allows 247 on-chain equity trading via regulated alternative trading systems, or ATS.
Right, and we have to look at why the SEC is suddenly okay with this. It really all stems from the DTCC pilot program.
The Depository Trust and Clearing Corporation.
Exactly. They are basically the central nervous system of the traditional stock market. And their pilot program, which ran under a 3-year no-action relief from the SEC, mechanically proved that traditional securities could settle on blockchains without the traditional 2-day settlement delay.
They showed it could handle the throughput.
Yeah, it gave the SEC the hard empirical data they needed to authorize these regulated ATS platforms.
And the scale is just staggering. I mean, looking at the data, tokenized stocks have already hit $33.7 billion in total distributed value.
$33 billion, wow.
Yeah, with over $3 billion in monthly transfer volume. And Ondo is commanding like 60% of this market right now.
That's insane.
You can trade tokenized NVIDIA at a daily volume of nearly $90 million. That's right behind it. Even Nasdaq is getting in on it. They just approved rule changes for tokenized Russell 1000 shares.
Meaning they carry the exact same economic rights and ticker symbols as the floor shares.
Exactly.
But none of this high-speed settlement works without the underlying payment rails. The PwC Global Crypto Regulation Report we reviewed makes it really clear stablecoins are no longer just some fringe experiment.
No, they are fully embedded now.
Yeah, they're part of the global monetary architecture. They're the infrastructure extending the U.S. dollar's reach to facilitate these instant settlements.
And PwC points out this really interesting dynamic they call co-opetition among traditional banks.
Co-opetition, yeah.
Basically, banks are realizing this stablecoin infrastructure is way too massive to monopolize. So instead of building proprietary stablecoins that can't talk to each other, they're sharing the underlying settlement rails to keep liquidity deep.
Right, and then they just compete ruthlessly on the client-facing stuff, the yield products, the custody services, whatever they build on top.
It's like telecom companies sharing cell towers but competing on service plans.
Exactly. But wait, let me push back a bit on this whole utopian vision.
Okay, go for it.
If all this traditional value moves on-chain, does it actually make markets more efficient? Because if we tokenize Apple stock and it suddenly trades on the traditional Nasdaq Q, on Ethereum, on Solana, and a dozen different ATS platforms.
Are we just creating unnecessary complexity?
Right. We might just be taking a centralized, highly efficient market and shattering it into a dozen illiquid fragments.
That is exactly what risk managers are screaming about right now. Tiger Research just published a piece on this exact systemic vulnerability. When liquidity fractures across disconnected blockchains, you inevitably get severe price tracking errors.
Okay, so mechanically, how does that slippage play out for an average retail trader?
Okay, so imagine a trader places a big market order for tokenized Apple stock on some smaller secondary blockchain. On the traditional Nasdaq Q, high-frequency market makers absorb that instantly, zero price impact.
Right.
But on this isolated blockchain, there just might not be enough automated liquidity or counterparties at that exact millisecond.
So it just eats through the thin order book.
Exactly, causing massive slippage. The trader pays a huge premium, and certainly the price of Apple on that specific chain is totally dislocated from the global market price.
Which instantly triggers aggressive arbitrage.
Instantly. Trading firms write bots to exploit the discrepancy, essentially extracting value from retail traders who just wanted to buy a stock.
Yeah, that arbitrage inherently drains efficiency from the system. And honestly, beyond the plumbing issues, there's a harsh macroeconomic reality that people love to ignore during these regulatory hype cycles.
Oh, totally. We looked at the virtual bacon analysis, and it cuts right through the hype. A piece of legislation does not override global liquidity cycles.
Nope.
If Bitcoin is stuck in a macro bear market, testing its moving averages down in the low $60,000 range, altcoins are getting dragged down with it.
Regardless of what bills are passing in Washington.
Exactly. If the foundational asset is bleeding, the Clarity Act isn't going to magically spark an altcoin bull run. Institutional capital deploys when the macro environment supports risk, not just because a legal taxonomy exists.
Very true. And speaking of reality checks, we really need to look at the intense political friction the Clarity Act is generating right now.
Yeah, and just a quick note for you listening. The sources here are heavily polarized. We are strictly staying impartial. We aren't taking sides. We're just breaking down the mechanics of these arguments so you know what forces are trying to derail this bill.
Right. And the most formidable resistance is definitely coming from organized labor. In May 2026, the AFL-CIO published a massive legislative alert opposing the act.
Vehemently opposing it.
Yeah. Their main grievance is procedural. They argued this whole framework was negotiated behind closed doors by the crypto industry and bank lobbies, completely shutting out consumer advocates and working people.
But their technical argument zeroes right in on those tokenized equities we were just talking about. The union warns that the Clarity Act essentially codifies what they call shadow stocks.
Shadow stocks, right.
And the mechanics of that are pretty alarming to traditional investors. If a platform creates an unbacked synthetic token that tracks a public company, and it trades offshore or on decentralized exchanges outside SEC jurisdiction.
It creates a totally parallel market.
Exactly. And the union argues this undermines all the foundational protections of the U.S. equities market.
Because traditional stockholders rely on SEC disclosures, audited financials, voting rights.
Right. If a huge chunk of a company's perceived value shifts to a shadow market on crypto rails, traditional stockholders lose visibility. They can't gauge market sentiment because the data is fractured across unregulated ledgers.
And taking it a step further, the union specifically tied this risk to retirement accounts.
Yeah, this was intense. They pointed to the new Department of Labor rules relaxing what 401k plans can hold.
Right, so the AFL-CIO's explicit fear is that the Clarity Act is just a Trojan horse.
Yep, designed to stuff pension plans and everyday retirement accounts with highly volatile digital assets.
Basically allowing crypto billionaires to cash out their bags using the retirement savings of American workers.
That's literally how they framed it. They keep drawing parallels to the 2008 financial crisis, comparing tokenized assets to credit default swaps.
You know, complex instruments that lobbied for light regulation and then destabilized the economy.
Exactly. Whether you agree with that or not, it shows you the heavy political ammunition being fired at this bill as we enter the final stages.
Which brings us to the actual legislative calendar. Where does it currently sit?
Well, the Clarity Act cleared the House,
Yeah.
and it successfully navigated out of the Senate Banking Committee. But the final boss is the Senate floor.
Passing the Senate means overcoming the filibuster, so they need 60 votes.
Right. Looking at the partisan split, the digital asset lobby has to hold all Republican support and secure at least 17 Democratic votes.
17 votes. That is going to determine the future of the U.S. crypto industry.
It really is. Strategists are targeting a full Senate floor vote in June or July, hoping to get it on the president's desk by July 4th.
But the path there is just covered in tripwires. Like, a single hostile amendment on the Senate floor could blow up the whole coalition.
Oh, yeah. If someone attaches an amendment stripping liability protections for DeFi developers, forcing them to register as brokers.
The crypto industry pulls support instantly.
Instantly. The bill collapses and the whole effort gets shelved until probably 2027 or beyond.
It's such a high-wire act. We are literally watching the real-time collision of decentralized tech and the deeply entrenched traditional financial system.
The U.S. government is finally being forced to write down the zoning laws for the digital economy. And the outcome of those 17 votes will decide if capital stays with American builders or if the infrastructure of the next century is built entirely overseas.
It's going to redefine the global movement of value.
It really is. And, that leaves me with a final thought for you to mull over as we watch this all play out. We talked about traditional equities like Tesla and NVIDIA trading 2047 on global blockchains via regulated ATS platforms.
Right.
If that frictionless, instant, always-on settlement truly becomes the global standard, what happens to the traditional stock exchange?
Oh, wow.
Right? Will the physical floors of the New York Stock Exchange, with their opening bells and weekend pauses, eventually just become completely obsolete?
Like, as liquidity migrates on-chain, those iconic trading floors might just end up as historical, illiquid backups to the blockchain.
Exactly. History shows us that when a digital layer proves it's cheaper and more accessible than the physical layer eventually becomes a museum.
Yeah, something to think about the next time you hear that opening bell ring on CNBC.
Definitely. Well, that wraps up today's deep dive. If you want to continuously track how these regulations are impacting markets and tech, make sure you subscribe to the podcast.
We'll be keeping a very close eye on the Senate floor and those 17 votes.
Until next time, stay curious, watch the macro, and always secure your private keys. Thanks for listening.